$24.1 billion. That is the size of the record backlog currently sitting inside a company that, honestly, the broader market still fundamentally misunderstands. When most people hear the name Eaton, they picture a 113-year-old legacy industrial company, maybe making truck transmissions or basic electrical boxes for a construction site. But that perception, it is entirely outdated. Today, Eaton is the absolute gatekeeper of the artificial intelligence power grid. Hyperscalers literally cannot build their AI factories without going through them first. And the core tension here is a massive market disconnect. Investors are pricing Eaton as if it's just riding some cyclical industrial wave, when in reality, they have positioned themselves as the indispensable toll booth for the largest infrastructure supercycle in modern history.
Just look at this number, $24.1 billion. And to be clear, this massive figure isn't coming from selling car parts or legacy combustion engine valves. This number actually represents a structural bottleneck in global infrastructure. Think about it. As artificial intelligence models grow exponentially, so does the power required to run them. The cloud giants, the hyperscalers building out this massive AI infrastructure, they are racing to build data centers, but they are hitting a physical wall. They cannot safely route, distribute, or cool the immense amounts of electricity these AI factories require without specialized, highly regulated equipment. Eaton is the one providing that equipment. This backlog isn't just a pipeline, it's concrete proof of their embedded, almost immovable position in the infrastructure value chain.
So how did they pull this off? Well, to understand it, we've got to look at their strategic pivot. The company has aggressively divested its lower-margin, cyclical vehicle segments over the last few years. And they are currently preparing to spin off their remaining mobility business, which still makes things like internal combustion valve trains, and a transaction expected to close in early 2027. It's almost ironic, right? A 113-year-old truck parts company is essentially holding the keys to the AI revolution. But this move will fully establish Eaton as a pure-play electrical and aerospace platform. They are shedding their legacy industrial skin to become a high-tech, grid-to-ship AI infrastructure powerhouse. And this is exactly what they sell, and honestly, why they win. First up, you've got low and medium voltage switchgear. This is the heavy-duty equipment that safely routes high-amperage electrical currents from the utility grid directly into the data center. Then you have power quality, things like uninterruptible power supply or UPS systems, and power distribution units that ensure those servers never lose power even for a single millisecond. But the real game changer here, it's the recent integration of Boyd Thermal. Eaton acquired Boyd for $9.55 billion specifically to bring engineered liquid cooling, cold plates, and coolant distribution units entirely in-house. This means Eaton now supplies literally everything, from the high-voltage substation switchgear all the way down to the liquid coolant keeping those server GPUs from literally melting into expensive puddles of silicone. Now, they also have a massive aerospace systems division managing flight controls for commercial and military aircraft, which is a great business, but in the context of this infrastructure boom, this grid-to-chip integration is their ultimate weapon. Now, if you want to know if that grid-to-chip strategy is actually working, you just have to look at this one metric. In the second quarter of 2026, Eaton experienced an 85% year-over-year surge in data center orders. 85%. That is a shocking growth metric for an industrial company of this size. It proves the sheer momentum of the AI infrastructure supercycle. You see, AI factories are entirely different beasts than traditional data centers. They consume up to 3 times the power. That extreme power density requires exactly the advanced thermal management and high-density distribution that Eaton just spent billions assembling.
So, you might be wondering, why can't a competitor just come in and undercut them on price? Well, it all comes down to deeply embedded switching costs. Once Eaton switchboards or hydraulic actuators are engineered into a billion-dollar facility or an aircraft design, you can't just swap out those mission-critical power systems without triggering ridiculously expensive technical redesigns and massive operational downtime. On top of that, you have massive regulatory protection. Competitors have to get safety recertifications from organizations like UL, IEC, or the FAA, which can take anywhere from 6 to 18 months. Plus, Eaton has dominant industrial distribution networks acting as a defensive barrier. In short, once Eaton is engineered into a project, they are almost impossible to dislodge.
Let's look at the hard evidence. When Eaton reported their Q2 results on Friday, July 31, 2026, the numbers were just exceptional. Consolidated net sales hit a record $8.53 billion, which is up 21% year-over-year, handily beating analyst expectations. Adjusted earnings per share came in at a record $3.15, beating the consensus by 8 cents, and segment operating margins held incredibly strong at 23.1%. This is the empirical evidence of immense operational leverage in action, and the market?
They clearly love these numbers, driving the stock up an incredible 7.6% on the day of the release, closing at $416.29.
And hey, real quick, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. All right, getting back to the story. Management didn't just beat estimates for the quarter, they actually accelerated their outlook. Eaton raised their full-year 2026 guidance, projecting organic sales growth to a range of 11% to 13% and bumping their adjusted EPS outlook up to a $13.50 midpoint. Listen, when management raises guidance like this while sitting on a $24 billion backlog, it is a massive signal of confidence. It tells investors they aren't just winning orders, they actually have the physical capacity to convert that backlog into realized revenue and earnings over the next year.
Now let's step back and look at the qualitative scorecard to understand the overall business quality. We rate companies across several dimensions on a scale from 1 to 10. Eaton scores a blended 8.4 out of 10, which is exceptional. Their revenue quality and market position are both sitting at an elite 9. The deep customer switching costs and clear near-term visibility from that massive backlog really drive that revenue score, while their absolute dominance in low to medium voltage switchgear secures their market position. However, it's not perfectly flawless. Financial health takes a slight hit down to a 7. Eaton recently took on significant debt to fund some of these acquisitions, bringing their total debt load to $20.61 billion in mid-2026. That leverage increases their near-term interest expense, and it's absolutely something we have to monitor closely.
Which brings us directly to the central conflict of this whole thesis. The market's biggest fear right now, execution risk. Yep, they have the orders, but can they actually execute a massive capacity ramp-up without completely crushing their own margins? Eaton is currently managing roughly 24 capacity expansion projects in North America alone. And if you know manufacturing, when you build new factories, you have underabsorbed overhead and intense training costs before those facilities are fully utilized. Add in the pressure of integrating that $9.55 billion Boyd Thermal acquisition and hitting those aggressive cross-selling synergy targets, and you have a very real operational tightrope that management has to walk over the next 18 months.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Portfolio Watch monitors your portfolio and flags important changes. Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of your screen. Scan it to download the Flash app and try it yourself. Or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, let's get back into the analysis. Before we look at the financial models, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. And remember, you can get the full, detailed model behind this analysis for free on Flash.
So let's walk through what Eaton might look like in 5 years, out to 2031, accounting for the $3.2 billion in revenue that's leaving when they spin off mobility. In our 60% probability base case, we assume an 8.5% organic revenue growth rate. Eaton successfully integrates their new factories and hits their targeted segment margin expansions, which drives overall net profit margins up to 18.5%. They pay down that debt and resume moderate share buybacks. Assigning a 26 times PE multiple gets us to a $55.59 share price, yielding a roughly 40% total return. But what if things go wrong? Let's look at the bear case. We assign this a 20% probability. Here, grid-permitting bottlenecks delay AI factory builds, and inflation completely crushes their margins, down to 15%. Debt remains heavy, so share buybacks are basically stalled. The market punishes them with a 20 times multiple, resulting in a share price dropping to $287.04. On the flip side, our 20% bull case assumes a flawless integration of Boyd Thermal liquid cooling, a massive, sustained surge in data center revenue at an 11% CAGR, and net margins expanding beautifully to 20%. The market rewards this absolute dominance with a 30 times multiple, rocketing the stock to nearly $800.
When we blend the math behind those exact assumptions and their probabilities, so 60% base, 20% bull, 20% bear, we get a probability-weighted 5-year implied share price target of $550.39. Based on today's closing price, around $416, that implies an annualized return of roughly 6% over the next 5 years, and that's not including the dividends you'd collect along the way. The opportunity here is driven heavily by their execution quality, but at this kind of premium valuation, we have to recognize that perfection is largely priced in.
Now, this brings us directly to the risks, and we need to clearly separate the early warning signs from the real structural thesis breakers. An early warning sign, that would be near-term margin compression. If those 24 new factories suffer from underabsorbed overhead, or if commodity prices for copper and steel spike out of nowhere, we might see their Electrical America segment operating margins miss management's guidance. That's painful for sure, but it's recoverable. A structural thesis breaker, on the other hand, is much more severe. If utility grid permitting completely stalls, or if the lead time for those massive medium voltage transformers pushes out to 100 weeks, then the hyperscalers physically cannot build their data centers as fast as they want to. If Eaton's customers get bottlenecked by the public utility grid, Eaton's order book is going to freeze, and that massive $24 billion backlog will take significantly longer to convert into actual realized revenue.
So let's bring this all together. If you take away anything from this analysis today, make it these 3 core points. First, Eaton is absolutely no longer just a legacy component maker. They are the indispensable toll booth for AI data center power, literally owning the infrastructure from the utility grid all the way down to the liquid cooling on the chip itself. Second, their record Q2 results prove they possess immense operational leverage and the ability to confidently guide future backlog conversion. And third, the only thing standing between them and a multi-decade run is their own execution. Integrating multi-billion-dollar acquisitions and standing up dozens of factories is incredibly difficult, and the market is watching this tightrope walk closely.
The AI infrastructure boom is moving faster than the grid can handle. The ultimate question is, will Eaton stumble under the massive weight of its own backlog, or are we looking at the closest thing to a guaranteed toll booth in the modern tech era? If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.